Mortgage rates finished last week at their highs again. As a result, the pace of home sales happening in July has slowed a bit. Overall, we're still tracking 3.5% more sales in 2026 so far than the same period last year. This week, we saw 82,000 newly pending home sales, and that was roughly the same number as the same week a year ago. Inventory inched higher for the week compared to the same week a year ago. And I've mentioned this is not unexpected. As demand slows, inventory grows. The supply picture for the rest of the year is for slightly expanding availability of homes on the market nationally. We can see supply growth in the inventory-starved Northeast, so that's a good sign. We have not seen inventory growth in Chicago, which has probably the deepest crisis shortage now for the country. New listings each week, meanwhile, stay pretty tight nationally. That means that buyers have slowly improving selection, but there's no flood or sudden surge in listings that change the buyer experience dramatically. Over our inventory forecast models, they now expect about 3 to 5% growth of inventory for the year of 2026 compared to 2025. Mortgage rates are now averaging 6.4% for the year to date. This is also not unexpected. It's actually right where we forecast the cost of money would be for the year. In the first quarter, rates were in the low sixes. In the second quarter, they marched into the upper sixes to average about 6.4% for the year so far. Last year, mortgage rates averaged around 6.7% for the full year. So what will it take for mortgage rates to ease lower again? Well, anytime we hear optimistic news out of the Middle East, the bond market rallies, and that helps borrowing costs. So maybe one of these times the good news will persist. As of now, the data suggests slightly improving selection for buyers amid slightly less demand competition than we had in the first half of the year. So let's take a look at the details. Let's start today with the supply picture. There are 1.1 million homes on the market now. That was up 0.8% for the week and just a fraction more than July of last year, the end of July. Inventory is basically unchanged year over year. The period through the end of July 2025, interest rates had climbed before beginning a 7-month slide lower. That transition moment was also when we began the process of inventory tightening across the country as well. Last year at this time, the inventory of unsold homes was 30% more than the year prior. Now inventory is unchanged from a year prior. This year, the opposite mortgage rate dynamic is underway. So rates are rising now. And so we're going to see if inventory grows again a bit compared to the year prior. I assume it will a bit. So it's interesting that the last week of July used to be pretty reliably the peak of inventory each year. In the post-pandemic years, though, the count of unsold homes at the end of July has been pretty close to the peak, but then we don't actually hit the year's maximum until all the way out in October. There's typically a long summer plateau of supply. Will bounce around 1.1 million homes on the market for a few months, gradually increasing to the peak in October. So in this chart, you can see the seasonal curve of inventory data with the summer plateau each year over the last decade. In August, September, and October, so supply is roughly around this maximum. If demand slows down, then the plateau shifts. So in 2022, for example, inventory started the year at crazy record lows, but then mortgage rates shot up, demand hit the brakes, and there was no summer plateau of supply. That year, inventory just climbed through the whole second and third quarters all the way into November. So that was very unusual and illustrates how rising rates equal rising inventory. You can see this typical summer plateau at the right end of the chart for the 2025 cycle. Inventory peaked October 20th last year. after staying in roughly the same zone for July, August, and September. The gray band here on this chart is the normal inventory levels over the previous decade. Last decade, there might have been 1.25 or 1.5 million homes for sale at the peak summer months. So there's still fewer than that now at 1.1 million. Overall, we're still in what I'd call a shortage of homes for sale across the country. It's not as dire as it has been in recent years. The shortage isn't as dire as it has been. And in some markets, there's ample inventory, but you might be surprised at how often I hear from our real estate professionals that their biggest challenge is finding supply for their home buyers. So for the rest of the year, it seems like we're on a path for a little supply growth. That's a good thing. Maybe 3 to 5% range for the year. That's less growth than we forecasted at the beginning of the year. I originally expected about 10% inventory growth for the year, but it does seem like it's picking up a little bit in recent weeks. There were 86,000 new listings this week. That's down a fraction for the week, which is normal for the season. We've been averaging about 3% more sellers each week than a year ago, so that's roughly proportional to the increase in transactions that we've seen. So they're related. In general, more sellers means more homes can sell. In this new listings chart, I've included 26, 2025, and then I'm contrasting that to 2022 and back in 2017. So together, these 4 years help us understand the supply side of the housing market right now. In 2022, sellers kept running for the exits later into the year. That orange line of 2022 here shows that we are still seeing 100,000 new listings each week well into July. In 2017, the gray line, it would be totally normal to have 100,000 new sellers in a given week. After hitting the max back in May at like 115,000 per week, May of 2017. But now we only get 86,000 sellers per week. So because American homeowners have such a strong financial position, very few need to sell their homes each week. Even if a demand shock hits the housing market, there is just no evidence of a supply wave coming. So if you hear like clickbait headlines about foreclosures, for example, no, there are just not nearly enough home sellers now to be panicking. There's no evidence that a ton of supply is coming, and demand moves quicker than supply. So we've measured only small increases in seller flow of housing this year, and that's growing at about the same pace as the pending sales compared to a year ago. So let's take a look at the pending sales. There are now an average of roughly 81,000 newly pending sales contracts each week. That's still ahead of last year's pace, but just barely for the month of July. Really, we're in a space where inventory and new listings are unchanged from last year, and sales are unchanged from last year, and in fact, prices are really unchanged from last year. So year to date, we've counted 3.5% more pending sales than a year ago. Our forecast for the year has been 4% growth. The market's playing out more or less as we described back in December. In this chart, the blue line, still a little bit above last year's purple line. After a decent period of growth in the second quarter, now the blue line is starting to trend more evenly with last year. So this chart is a 4-week rolling average. It smooths out weekly jumps and dips for like holiday weeks. The next holiday is Labor Day, which is actually late this year, Monday, September 8th. So inventory and sales will dip then. But until then, I expect to keep roughly on this 80,000 per week pace. It eases a little bit lower each week in August. Home prices are holding steady at just under 400,000 for median price of the pending home sales this week. That's essentially unchanged from last year, just 0.2% above last year. The data suggests that home prices will stay roughly unchanged for the year. This is the same pace they've been at, and I haven't seen any data that would imply notable price changes, either up or down from here. It would take a big shock to demand, like mortgage rate spike or stock market correction, to move home prices notably now. If you're interested in a scenario where home prices move lower, here's what I'd be on the watch for. First, one of these demand shocks happen. These can happen, and they are not predictable in advance. The most recent one was at June of 2022. That was when mortgage rates surged way beyond expectations. Next, after that demand shock, we then see weekly sales numbers come in notably below the seasonal norm. Demand moves faster than supply, so in those same weeks, as demand would dip, inventory would gap higher. And again, we saw that in 2022. We'd see big changes in the price reductions each week. Then the last step is that we'd be able to measure declines in the weekly pending sales prices. Prices are the last thing to move. So you can see that whole pattern in the gray line for 22 on this chart. See the steps down for home prices in June of 22 and again in October of that year. Notice that those dire price scenarios are not happening now. Those shocks could happen and could shift home prices lower, but for now, things are playing out pretty far as expected. There are plenty of places around the country, including Chicago and New York, where inventory is still so tight that home prices are appreciating at like 5% or more over last year. Other cities like San Francisco and Miami, where home prices were heading lower, they have now flipped and are shifting higher. Of the big 20 cities in the Case-Shiller Index, 11 of them have home price appreciation versus last year. 9 have home prices below 2025. Overall, for the whole country, home prices are essentially unchanged from last year. This pace seems unlikely to change for the near-term future. I will close today with price reductions. Price reductions are inching higher. That is something to keep watching. 41% of the homes on the market have taken a price cut from the original list price. Last year, there were slightly more, but now it's increasing faster than last year. So in this chart, each line is a year. We can use the weekly as a gauge of how home buyers react to changes in mortgage rates and other economic drivers. So I think this one will be interesting to watch over the next few weeks. In years like 2023, that's the yellow line here. Demand was really slowing again in the second half of the year, and price cuts rose quickly through August and, in fact, all the way into November of 2023. That demand shift told us a lot about growing inventory and flattening home prices into 2024. Price cuts are moving higher now, which shouldn't be surprising, right? Mortgage rates are at their highest for the year, but they're not. They haven't yet crossed over above the 2025 levels. So stay tuned for more as August progresses.